one of the things that the vast majority of Americans, I would bet 99% of Americans who don't watch this program or listen to this program don't understand is how CEOs and senior executives get insanely rich. And I'm talking about like hundreds of millions of dollars, billions of dollars, how they get insanely rich with stock buybacks in publicly traded companies. And just a real quick recap. I've done this, a couple of times here, but I don't think it can be said enough because it takes a while for people to really get it. Say you've got a company that is worth $1 billion and has 1 million shares outstanding, 1 million shares of stock for a company worth $1 billion. Okay, so each share of stock is worth $100. Now, there's different ways you value companies and, price to earnings ratios and percentage of sales and all that kind of stuff. But set all that aside for the moment. Let's just say there has been a valuation. This company's worth $1 billion. It's got 1 million shares. Therefore, every share is worth $100, if I'm doing my math right? Or no, every share would be worth $1,000 because $1 billion is 1,000 million. Right, okay. So every share is worth $1,000. Now, let's say you're the CEO of the company and your company made, let's say, for example, hang on, I have an actual real number for you. Let's say your company, in this case, it was $2.5 billion last year. Well, we can't use that example because we've only got $1 billion company. So let's say your company made $300 million in profits. And your company is a bank. I want to talk specifically about banks. Now, that $300 billion could add to the value of the company. It could be, well, if you're a bank, you could use that $300 billion to lend, it's now money in the bank at the bank, right? It's profit. So the bank could roll that money back into its operating capital, and it could lend out 10 times that, $3 billion worth of money. It could, it could literally invigorate the economy. However, because the senior executives are compensated with stock options, and the way a stock option works is, say I work at this company, the shares are selling for $1,000 a share right now. As part of my compensation, I get the deal that I can take stock options anytime during this year, and then I can turn them in anytime next year and sell them and only pay a maximum 25% income tax because it's a capital gain, right? Or 20% income tax because it's capital gain. So it's like super good money. So what I do is I instruct my company, instead of lending out $3 billion based on that $300 million of capital, I instruct my company to take that $300 million and buy back shares. Now, there's 1 million shares out there. It's worth $1 billion, so 300 million. So we're buying back about 1/3 of the shares of the company. What does that do? It raises the stock price by about 1/3. So that $100 share of stock is now selling for, 100 plus 1/3 of 100, $130 or $1,300 a share. So then I take my stock options that I got at $1,000 a share and I sell them at $1,300 a share. I make a $300 profit on every stock certificate I've got, and say I get, 1 million of them a year. So, you can, or 1,000. Anyhow, you get how it works. A CEO of a bank has a choice. When the bank makes a profit, they can either use that profit to stimulate the economy by doing what banks are supposed to do, which is lend money out to people, or they can take that profit, buy back shares from the company, have the company retire shares from the marketplace, reduce the total number of shares in circulation, which raises the value of all those shares, and then the executives cash in the shares and put the money in their own pocket. So basically, the CEO of, and this is true of any company in America, and this is a game that every single, as far as I know, every publicly traded company that I've looked at is playing. This is the new way to make money in America for the CEO class. They have their company do share buybacks, which inflates the value of their stock options. So they walk away with hundreds of millions of dollars. But what the company does doesn't grow, doesn't expand, doesn't help the economy, doesn't hire new people. If it's a bank, doesn't lend more money to people. It basically screws everybody in America except the CEOs and the senior executives and the major stockholders. Now, this is all a result of changes in tax law during the Reagan era. But to give you a clear, frighteningly clear example of this, this comes from a fellow by the name of Thomas Hoenig, H-O-E-N-I-G. I'm not sure exactly how he pronounces it, but if he were pronouncing it, you know, the German would be Hoenig. It's probably Honig or something like that. Anyhow, he was the vice chair of the, or is the vice chair of the Federal Deposit Insurance Corporation right now. He's the number 2 guy at the FDIC. Before that, he used to be on the Fed, and he sent a letter to the Senate Banking Committee Chairman Mike Crapo and the committee's senior Democrat Sherrod Brown. And Reuters is reporting on this. And in his letter, he pointed out that the 10 largest banks in America took 100% of their profits, and instead of using that money as additional capital that the bank has that it can use to loan money against, simply bought back shares and inflated the paychecks of their CEOs. The worst was J.P. Morgan Chase, Jamie Dimon's bank. They made $2.5 billion last year, used it all for share buybacks. This is all, by the way, according to an article on Wolf Street. Howling About Business, Finance, and Money is the subtitle. It's by Wolf Richter, R-I-C-H-T-E-R. The headline is, Mega Banks Blow 100% of Earnings on Share Buybacks and Dividends, Crimp Lending, Constrain Economy. That's the headline. And he noted J.P. Morgan Chase, $2.5 billion, Bank of America, $2.25 billion, Wells Fargo, $1.9 billion, Citigroup, $1.8 billion, Goldman Sachs, $894 billion, Morgan Stanley, $832 billion, U.S. Bancorp, $450 billion, PNC Financial Services, $371 billion, TD Group U.S. Holdings, $353 billion, Capital One Financial, $349 billion, a total of $11,819 million. You with me so far? Excuse me, $11,819 billion. Okay. Yeah, because 1,000 billion is a trillion. Okay, so $11 trillion. I mean, it's mind-boggling. This is from wolfstreet.com, based on the S&P Global Market Intelligence. They could have they could have increased lending in the United States by $1 trillion. $1 trillion. And instead, they just passed that money out to their executives. They note in the article, Wolf Richter notes in the article, the CEO of the top bank on this list has been very vocal about plowing more of the bank's income into shares, buybacks, and dividends while pushing regulators to lower capital requirements. And when the guy who wrote this letter to Sherrod Brown, he was the president of the Kansas City Fed and a member of the Fed's policy-setting Federal Open Market Committee from 91 to 2011 through the financial crisis. J.P. Morgan Chase earned, and just looking at the first part of this year, J.P. Morgan Chase earned $26 billion over the, or excuse me, this is the last year. J.P. Morgan Chase earned $26 billion over the 4 quarters, but it plowed $27.6 billion, or 106% of its income into share buybacks and dividends. If it had retained that income, it could have raised its capital by that amount, and that would have been enough to make an additional $250 billion of loans under current capital rules. So, you know, basically they can loan 10 times what they have in capital. Share buybacks alone amounted to $83 billion, not counting dividends. If banks were to retain this capital, instead of buying their own shares with it, they could have increased commercial and consumer loans by $741 billion. If they cut dividend payments some, they could have boosted their lending by over $1 trillion. These banks could have done what banks are chartered to do, which is help the economy. Instead, they made their executives richer. Something very, very wrong with it.